The dollar is dying. Or is it a trap? Cold open. China and Brazil just shook hands and said, "We don't need you anymore." Saudi Arabia is pricing oil deals in yuan. Russia is trading in rubles and rupees. The BRICS nations, Brazil, Russia, India, China, and South Africa, are openly discussing a new reserve currency to replace the dollar. The IMF says the dollar's share of global reserves just hit a 25-year low. Ray Dalio has warned that big economic and political orders shift in long cycles, with ugly transition windows that can last 10 to 20 years. And if you've been anywhere near financial Twitter, YouTube, or Reddit in the last 2 years, you've seen the headline, "The dollar is dying." But here's what nobody's telling you. What if the dollar dying is actually the trap? What if the countries trying to escape the dollar are actually making it stronger? Today, we're going to walk through the most important monetary debate of our lifetime. We'll look at the real evidence that the dollar's dominance is slipping, and then we're going to flip the whole thing upside down with something called the dollar milkshake theory, which by the end of this video might completely change how you think about your money. Let's get into it. The scary reality. De-dollarization is real. Let's start with the part that sounds scary, because honestly, it is real. The people saying the dollar is in trouble are not wrong about the data. They may just be wrong about what it means. Here's what we know. In 2023, China and Brazil announced they would settle trade directly in yuan and reais, completely bypassing the US dollar. Even official explainers on the Brazil side confirmed that the dollar no longer has to be the mandatory middleman. It can still be used, but now it's optional. That matters because every time a country builds payment rails that bypass the dollar loses a little bit of automatic demand. Saudi Arabia, the country that basically gave the dollar its post-1971 superpower by pricing oil exclusively in dollars, that petrodollar deal, has started accepting yuan for some oil sales. That is a seismic shift. And this isn't happening in a vacuum. Ray Dalio, founder of Bridgewater Associates and the world's largest hedge fund, wrote a book called The Changing World Order. His core argument, reserve currencies follow roughly 100-year cycles. The Dutch guilder dominated global trade in the 1600s, the British pound took over in the 1800s, the US dollar became the world reserve currency after World War II, and we've now been the dominant reserve currency for about 80 years. Dalio's framework says big debt, political, and power cycles tend to run over very long periods, roughly 50 to 100 years, with destructive transition phases that often last 10 to 20 years. His point isn't that reserve systems vanish overnight like someone flipping a light switch. It's that if the global monetary order is changing, it probably won't look like one dramatic collapse. It'll look messy, gradual, and then suddenly very fast. And looking at the data, it's hard to completely dismiss him. The numbers. In 2001, the US dollar made up 73% of global foreign exchange reserves. The Fed's latest data puts it at 58% of disclosed global reserves in 2024. That's a 15 percentage point decline over 2 decades. The dollar is still dominant, but it is measurably less dominant than it was. Central banks around the world have been quietly diversifying, buying gold, holding more euros, more yuan, more of a basket of currencies. The trend is real and documented. So yes, de-dollarization is happening. But this is where it gets interesting, because there's a second story, and this one doesn't get nearly as much airtime, and it involves a milkshake. The counterintuitive twist, the dollar milkshake theory. Okay, imagine you're at a diner. There are 5 people at the table, everyone orders their own milkshake, but then you pull out a giant straw, and your straw reaches every single glass on the table. You start drinking. That is essentially what the dollar milkshake theory says the United States does to the rest of the world. The theory was developed by macro investor Brent Johnson, and the core idea is this. Yes, the world wants to move away from the dollar. Yes, countries are signing bilateral trade deals in local currencies. Yes, central banks are diversifying reserves. But here's the problem they cannot escape. The dollar's power is not just about trade, it's about debt. When a Brazilian company borrows money internationally, they borrow in dollars. When a Turkish bank raises capital from foreign investors, it issues dollar-denominated bonds. When an Indonesian company builds infrastructure, the loan is often in dollars. Why? Because global capital markets run on dollars. It's the deepest, most liquid, most trusted market on Earth. And the numbers here are enormous. The Fed estimates about 60% of global foreign currency debt is denominated in dollars. BIS data puts dollar credit to non-bank borrowers outside the United States at $13.2 trillion as of end 2024. Non-US banks had roughly $21 trillion in on-balance sheet dollar liabilities by end 2023, with off-balance sheet dollar obligations via FX swaps estimated at roughly double that. So even if countries want to ditch the dollar for trade, they are still tied into a giant dollar debt machine. Now here's where it gets really gnarly. When those debts come due, or when interest payments are due every single quarter, those companies and governments need dollars. Not yuan, not euros, dollars, because the debt is in dollars. So what happens when the dollar strengthens, or when dollar liquidity tightens? These countries and companies are forced to go into the open market and buy dollars. To do that, they have to sell their own assets, their own currency, their own stocks, their own bonds, to raise the dollars they need. This is exactly what happened in 2018 when the Fed raised rates. The Turkish lira collapsed, the Argentine peso collapsed, the South African rand tanked. Not because anything fundamentally changed in those countries overnight, but because dollar tightening triggered a global scramble for dollars that crushed their currencies. Think about what that means. The countries most vocally trying to escape the dollar are often the same countries most trapped by dollar-denominated debt. It's like they're at the table saying, "I don't want your milkshake anymore," while your giant straw is already draining their glass. You know GameStop? When a stock is heavily shorted, meaning lots of people have bet it will go down, and then it starts rising instead, those short sellers are forced to buy the stock to cover their losses, which causes the price to rise more, which forces more short sellers to buy. It's a squeeze. The dollar milkshake theory says the same dynamic exists for the US dollar on a global scale. The more countries bet against it, by issuing local currency debt, by signing non-dollar trade deals, the more exposed they become if the dollar ever strengthens unexpectedly, because all that underlying dollar debt is still there ticking with the clock. The key insight: the dollar's power doesn't just come from trade. It comes from the fact that the world has borrowed in dollars for 80 years, and those debts don't go away just because China and Brazil shook hands. The hidden demand nobody talks about. Now let me give you a specific number that will make this click. Every year, the interest payments on existing US dollar-denominated debt around the world generate somewhere between $1 and $2 trillion in demand for the US dollar, not from trade, not from oil, just from interest payments on debts that already exist. Think about what that means. Even if every country on Earth stopped using dollars for international trade tomorrow, completely, overnight, there would still be this massive, structural, unavoidable demand for dollars, because the debt clock doesn't stop. Every quarter, Brazilian companies send dollars to their American creditors. Every year, Korean banks pay interest in dollars on bonds they issued on Wall Street. Every month, sovereign governments across the developing world are writing checks in dollars to pension funds in New York and London. This is what makes the dollar uniquely sticky. It's not just about what currency you use to buy oil today. It's about the debt you took on in dollars 20 years ago that you're still paying interest on right now. And here's the cruel irony of de-dollarization. When a country like China or Russia accumulates dollar reserves and then loudly announces they're diversifying away, what they're often doing is selling US Treasury bonds, which, yes, reduces the dollar's share of their official reserves. But the underlying dollar debt in the private sector, the corporate bonds, the project finance loans, the trade credit, that doesn't disappear. It just keeps generating demand, quietly, every single quarter. The headline says China dumps US Treasuries. The reality is, a Brazilian soybean exporter still needs to service his dollar-denominated loan. And here's the stat that ties it all together. Even at a 25-year low in its share of global reserves, the US dollar still accounts for roughly 88% of all foreign exchange transactions worldwide, according to the Bank for International Settlements. SWIFT's tracker for April 2025 showed the dollar at 49.68% of global payments versus 22.24% for the euro and just 3.50% for the renminbi. The reserve share is declining. The transaction dominance is nearly unchanged. That is not a dead currency. That is still the operating system of global finance.
Okay, so we've established two things. One, the dollar's dominance is slowly eroding. De-dollarization is real. Two, the dollar is structurally locked in as the world's currency by trillions in existing debt, creating a demand floor that won't disappear easily. But now I want to introduce a third layer that almost nobody mentions when this subject comes up. The United States might actually want a weaker dollar. I know, that sounds insane. Why would America want its own currency to weaken? To understand this, you have to understand that there are actually two Americas, and they want opposite things. The first America is what I'll call financialized America. Wall Street, the big banks, the asset managers, the import-heavy retail chains, the tech companies that manufacture in Asia. Financialized America loves a strong dollar. Why? Because a strong dollar makes imports cheap. Your American money goes further when you're buying goods from China, clothes from Bangladesh, or electronics from Taiwan. A strong dollar also makes U.S. financial assets attractive to foreign investors, keeping capital flowing into stocks, bonds, and real estate. The New York Fed is clear about this. Dollar strength supports the financialized side of the economy by making imported inputs cheaper and keeping foreign capital interested. Financialized America has been winning for the last 40 years, and the strong dollar has been a big part of that. But there's a second America. Call it productive America. The Rust Belt, Ohio manufacturing plants, Texas refineries, North Carolina furniture makers, Michigan auto workers. Productive America makes things and tries to sell them to the world, and a strong dollar absolutely crushes them. Imagine you're an American steel company trying to sell steel to a European buyer. You price your steel in dollars. Your German competitor prices theirs in euros. If the dollar is strong, $1 buys 1.20 euros, your steel is expensive in European terms. The German steel looks like a bargain. You lose the sale. If the dollar is weak, $1 buys 0.85 euros, suddenly your steel is competitively priced. You win business. You hire workers. The factory runs. A strong dollar means cheap imports and expensive exports. A weak dollar means expensive imports and competitive exports. Financialized America wants to be strong. Productive America needs to be weak. Policy analyst Stephen Mirren's widely circulated paper makes the same argument in more explicit terms. Persistent dollar overvaluation has hurt manufacturing competitiveness for decades, while benefiting the financialized sectors that captured most of the gains from globalization. Here's why this matters right now. There's a growing political movement crossing party lines to re-industrialize America. Reshoring, made in America. Rebuild the supply chains hollowed out over 30 years. But here's the dirty secret. You cannot re-industrialize with a strong currency. It is mathematically almost impossible to outcompete countries with cheaper labor when a stronger currency is also working against you. So if the policy goal is to rebuild American manufacturing, and there's bipartisan support for that goal, you arguably need a weaker dollar, which means de-dollarization might not be something the U.S. is passively watching happen. Maybe it's something the U.S. actually wants.
This brings us to what might be the most audacious financial idea floating around policy circles right now. It's being called the MAR-A-LAGO Accord. To understand it, you need to know about the original Plaza Accord. In September 1985, finance ministers and central bank governors from the US, West Germany, Japan, France, and the UK met at the Plaza Hotel in New York. They had a problem. The US dollar had gotten so strong that American manufacturers were being wiped out by cheaper foreign competition. Sound familiar? So they made a deal. They agreed to coordinate intervention in currency markets to deliberately weaken the US dollar, and it worked. Within 2 years, the dollar had fallen roughly 50% against the yen and the Deutschmark. American exports became competitive again. The MAR-A-LAGO Accord idea is essentially a 21st century version of that, but bigger, messier, and far more contested. The concept, laid out explicitly in Stephen Mirren's policy essay, goes like this. The US dollar has gotten so strong and the global debt burden so enormous that the world is heading toward either a deflationary collapse, where debtors can't pay, assets crash, economies implode, or a managed, coordinated devaluation of the dollar to relieve the pressure on the system, restore American manufacturing competitiveness, and rebalance global trade. The logic: if the dollar weakens significantly, all that dollar-denominated debt around the world suddenly becomes easier to service. Emerging markets get relief, global trade picks up, and American manufacturing gets a massive boost from the more competitive exchange rate.
The catch? The Council on Foreign Relations points out that even a coordinated dollar weakening may not automatically fix the U.S. trade deficit, because structural issues like China's industrial capacity and global supply chains run far deeper than exchange rates alone. And a weaker dollar means higher inflation at home. Your imported iPhone costs more. Your grocery bill goes up. It also means the U.S. has to surrender some of the financial privilege it has enjoyed for 80 years, what French economist Valéry Giscard d'Estaing called in the 1960s the exorbitant privilege of printing the world's reserve currency and having everyone accept it. The core tension? A coordinated dollar devaluation helps productive America and relieves global debt pressure, but it hurts financialized America and could accelerate the very de-dollarization that worries people in the first place. Is this definitely happening? No, nobody knows. It might never fully materialize. It might already be quietly underway. But the fact that serious economists and policy advisors are openly discussing it tells you something important. The dollar's future is not just a question of market forces. It is a question of political choices. And the people in power right now seem more interested in a weaker dollar than any U.S. administration in a generation. In plain English, the endgame may not be dollar death. It may be managed dollar devaluation, not because America is weak, but because the system becomes too unstable with a dollar that's too strong. The trap wasn't that the dollar disappears. The trap is that the world can't function smoothly with either too little dollar demand or too much of it.
What you should actually do with this. Okay, I know that was a lot. Let me bring it back down to earth. You're not a central banker. You're not running a hedge fund. You're a person with a job and a bank account and maybe some investments, trying to figure out whether any of this should change what you do with your money. Here's my honest take. First, don't panic trade the end of the dollar. The dollar's decline has been happening for 20 years, and it has happened very slowly. Going from 73% of global reserves to 58% over 2 decades is a trend, not a crisis. The Fed still shows the dollar on one side of about 88% of all FX transactions globally. SWIFT's latest data puts it at nearly 50% of international payments. The yuan sits at 3.5%. We are not in a post-dollar world. We are in a slightly less dollar-dominated world. There is a real difference, and you have time. Second, diversification is always right, and it's especially right now. If you're 100% in US dollar-denominated cash savings, you are carrying currency risk you may not even be aware of. Broad index funds with international exposure are actually quite sensible here. If the dollar weakens, international stocks rise in dollar terms. You're naturally hedged without doing anything exotic. Third, consider hard assets. Gold has been the go-to hedge against currency debasement for literally thousands of years. Central banks themselves are buying gold right now at the fastest pace since the 1960s. That is not a coincidence. I'm not saying put everything in gold, but a 5 to 10% allocation to gold or a gold ETF is a reasonable insurance policy against policy error, currency debasement, or financial system stress. Fourth, real assets and cash flow generating investments tend to hold their value when currencies weaken. If you own a house with a fixed-rate mortgage and inflation runs hot, your debt is being inflated away while your asset holds its real value. Productive businesses with pricing power, the kind inside a broad index fund, do the same thing. Not the worst position to be in. Fifth, and this one matters, watch the plumbing, not the slogans. The future of the dollar won't be decided by speeches. Watch reserve shares. Watch SWIFT usage data. Watch FX funding stress in emerging markets. Watch whether the U.S. starts openly pursuing a weaker dollar for industrial policy reasons. Headlines tell you the story politicians want to tell. Balance sheet plumbing, the BIS data, the Fed's flow of funds reports, offshore dollar credit figures, tells you the story the system is actually living through.
Final punch. So, is the dollar dying? Maybe, slowly in prestige. Maybe, partially in reserve share. Maybe, politically, in the ambitions of countries that want another option. But is it a trap? Absolutely, because the same world that wants to escape the dollar is still built on dollar debts, dollar funding, dollar trade, dollar banking,
and dollar collateral. And until that changes, structurally, in the balance sheets of companies and governments everywhere, every attempt to leave the system may end up feeding the system all over again. That's the real mindbender. The dollar's greatest weakness is obvious to everyone. Its greatest strength is hidden in the fine print of everybody else's liabilities. The dollar may not be dying. It may be forcing the rest of the world to keep drinking the milkshake. If this made you think differently about your money, hit the like button. It genuinely helps this channel reach more people. And drop a comment. Do you think the dollar is dying, or do you think it's a trap? I want to know where you land. I'll see you next week.